studying.
Yes. Or else a few people are going to be upset if I don't do that. I have to re-record the session. One time I did a webinar, I totally forgot to record it, and a couple other technical difficulties, and so I actually sat down and redid the webinar by myself and sent it out to everybody. So anyway, okay, so let me get to the screen. All right, so, oh, I'm sorry, I'm at the beginning. All right, so let's talk about the problem. You know, if you use a standard costing system, I guess the easiest way to describe it is it has a great deal of influence on the reported profit. The main reason that happens is because it is valuing inventory. The way that most systems work, you know, you set the standards, it values inventory at a standard cost, and then and so you have to make your income statement be at actual, and so that's how all these variances come out, because it's the difference between actual and standard. And but it gets very, very confusing. So here is a typical standard costing based income statement where you see in period 2 that the sales were greater than period 1. However, the margin was less. And so that's always confusing to people. We shipped more, but our margin is less. And anybody want to take a guess at what the usual explanation of that is?
It's overhead absorption.
Yeah, overhead absorption. And a lot of people also right there, just when you're looking at the margin, they say, oh, product mix. You know, the mix of products in period 2 was different than period 1, and their costs were different. Mm. And then you get into this whole basket of variances, which are for people who don't really understand how a standard costing system works, these variances are, I'd say, very confusing, okay? You know, we talked about how some of these variances, we talked on Tuesday about how some of these variances are used for performance reporting, but I remember also when I first started as a CFO and having to try to explain these variances, it's confusing, frustrating. You have things also, my friend Jerry Solomon, who really will go, he has a very humorous way to explain all this. He says, you know, you don't even understand the parenthesis. You know, does the parenthesis mean it's good or it's bad? You know, it gets very confusing. And so, you know, what you end up seeing, if you look at the profit before tax line, period 1, profit was about 100,000 more than period 2. And that really, really just confuses people. And so then you get into sort of companies sometimes fall into the trap. Well, we need more detail. We need more analysis so that we can better understand this. And if this format of a income statement is used internally, it really confuses non-financial people. So, you know, if you presented this to operations and said, you know, explain it, you know, they would say, well, you know, our sales are based on what the orders were and what we were able to ship. So we have no control over the cost of goods sold number because that's a calculated number. You know, the variances, they might offer some explanations, but they're hard, you know, it's hard to understand if the explanation is valid or not, because with a variance, you don't know if the actual is valid and the standard was off. Maybe the standard is just, you know, sort of not accurate anymore, or is the standard accurate and the actual is off? It's very, very confusing. I always use the saying that trying to analyze variances is like watching a dog chase its tail. The dog never catches its tail and just keeps going around in circles. So it's confusing. And by the way, I don't know if any of you do this or not. There's two stories about all these variances. I've worked with some companies that in their budgeting process, they actually try to budget what the variances are going to be. Anybody do that? That gets really, really, really confusing. How do you budget a variance? You know, you're trying to predict what's going to happen, and that's really difficult. The other thing is that, I don't know, again, if any of you have seen this in your careers or not, but sometimes the variances are so large and have such an impact on profitability that the company capitalizes the variance. So they put it onto the balance sheet, and then they move a portion of it back to the income statement on an even amount every month, so as to not to skew the profits. Again, those are not solutions to the problem. That's the issue. They're trying to just deal with the problem. So those are a lot of problems with standard costing based income statements when you're using them internally. So what we want to do is move to more of what we call a plain English or a value stream income statement. So what are the characteristics here? Number one is we're going to show actual costs. Now, the actual costs for the reporting period are different. They're not necessarily the same as cost of goods sold based on a standard costing system. So what you see here, when you look at the actual manufacturing costs, that we shipped more in period 2 in the current month, and our actual margin was higher, which is what you'd expect. You can also see some differences in all the actual costs. Some were higher in current month than the prior month, and also vice versa. And then you can take all those inventory valuation transactions and lump them just into one number, inventory adjustment, okay? And so what you get, then you have the operating profit, you can have your SG&A expenses, and then you can see it's more revealing why the profit before tax is less in period 2 than period 1. How would you, what would you say? You know, what was the primary reason operating profit in the current month is less than the prior month?
We sold products with a lot of overhead in their cost.
Okay, yeah. There's no right or wrong answer here. Right. the inventory adjustment had a lot to do with it. And, you know, that's, if you take what the standard cost of goods sold is, if you take the overhead absorption numbers, if you take all the variances, and if you sort of just put, you know, sum them into one number, you know, you can see that all those, you know, cost accounting transactions had a greater impact in period 2 than period 1. And there's lots of reasons for it. For example, you could have sold more than you produced. Like we talked about the variances, they're all in there. But what you get out of this is you get a true operating margin that now you can really analyze based on actual operating practices. Yeah, and then for financial reporting, we know the primary reason why profits were lower. So that's the idea is, and we're going to go into this in more detail after we do the exercise about how to develop these documents. What's important to understand is that this is for internal use. Okay, so we're not suggesting, or we're not saying change the format for your external reporting. All right, so let's we're going to move into the exercise. So open up exercise 2, and I'm going to open it up on the screen, and we'll walk through it. Okay, and this one's a little more complicated than Tuesdays, so let me start over here. So we have a simple value stream with 2 products, product A, product B. And here are the, you know, this is the process: prepare for mounting, mount components, align and secure, inspect and pack. And you can see the process times. Product A, 6 minutes, 3 minutes, 4 minutes, 4 minutes. Product B, 6, 6, 6, and 6. Right? So let me go over here and walk through, and we'll do these one at a time. So
I hate to bug you. Sorry, I hate to bug you. Can you send out the exercise 2? I don't seem to have it.
Oh, okay. Hold on one second. Sorry you didn't get it. Let me, I think I can insert it to the chat. Hold on. It'll. Exercise 2. Okay, it should be in the chat pane, and you should be able to download it from there. Did you get it? That Jason?
Yes, I'm downloading it now. Thanks.
Okay. All right. So let me go back. All right. So much like Tuesday's exercise, here's some product cost information. That the material costs for product A and product B are the same, $42 a unit. The direct labor rate per hour is $25, and the overhead rate per direct labor dollars is 600%. So in part 1, calculate the standard margin of both products. Go ahead and do that. And again, you take the direct labor rate per hour divided by 60, multiply it by the number of minutes that it takes to produce each product. The overhead in row 12 will calculate automatically. It's a formula. And you have to put in the material cost per unit. And by the way, this exercise is also based on a real life company that we worked with at one time. Same thing was true of Tuesday's exercise. But the names have been changed. Well, we're not using any names. And we also had to sort of simplify the exercise a bit.
Hey, Nick, I apologize. It's not letting me download it. So
Okay.
I don't know if it's my system constraint or.
Okay, not a problem. Not a problem. Here, I'm going to send you the email.
Apologies. Thanks.
Oh, no, that's fine. Let me, hold on, I got to move. I'll also send you exercise 3 and 4 while I'm at it. All right, they're on their way.
Thanks.
You're welcome. Okay, so back. Okay, so what did you get as answers? Anybody?
Material flows right down is 42 per unit.
Yeah.
Labor on product A, I have $7.08 per unit.
That's correct.
And $10 on product B.
Yeah.
And the rest of the chart fills in.
Yeah. And so you can see the answers there. And again, why is the cost of product B more than product A when they're very, very similar products?
Takes a little bit longer to make product B.
Yes, yes, that is the correct answer.
And like yesterday, the bottleneck is at 6 minutes for both of products.
Yes, yes, good, good. I was going to ask that question. No, that's good. I'm glad you brought that up. That's it. It's you can make the same amount of A or B or any combination of A or B in 1 hour. It's 10 units. That's all you can make. So the output, is the same. And again, so let me just continue with this story. So I'm going to scroll down a bit. The policy in this company was that any product with a margin of less than a standard margin less than 30% had to be outsourced. So what happens to product B?
Outsourced.
It gets outsourced. Okay. So what I'd like you to do, well, I'll give you the answer to this because it's quite simple. You know, the product B, the margin for product B now goes up to 43.3% because the only cost is the $85 of material. So, but what I want you to do is go down to number 3. And I want you to do number 3 and then answer number 4 and answer number 5. So, okay, product B is now just, it's outsourced. So there's, you know, not a whole lot of actual production that goes on. So in the meantime, you know, what happens is the standards are reset, and now the overhead rate for A goes up from 600% to 1,000%. So what would the new cost of A be? And what would the cost of B be? And what would be the standard margins?
Margins would go, for A would drop to 20.08%.
Yeah. Anybody else get that? Here, I'll show you. Yeah. The resources stay the same. So the overhead stays the same. So now what happens to product A?
It's outsourced.
It's outsourced. Now what happens to the value stream?
Shut down.
It shuts down. Yeah. I worked at a company that they had been, they were using standard costing to determine insourcing and outsourcing. And they had this huge facility. And these were highly precisioned products. They needed a lot of engineering support. Okay, when it wasn't like they were just making simple products. And so they had been doing this for a number of years. And their margin and their profit had steadily declined, even though their sales were still pretty good. And one of the reasons they called us up and brought us in is they wanted to help figure out why. And so this is really what they did, is their overhead, like engineering and sales and support, more like the administrative overhead, that was all still there. The only thing they did was every time they outsourced, they just got rid of some of the direct labor. And this is we like to call this the overhead death spiral, meaning you outsource, overhead rates go up, you outsource more, and pretty soon everything just it's sort of like a black hole in space. Everything just collapses on itself. So this is the danger of, using, standard costing profitability to make some business decisions. So now what we're going to do is exercise number 2. Okay, and we're going to do it outsourcing. I'm sorry, we're going to do it with, we're going to assume the outsourcing has gone on, and we're going to look at it from more of a value stream accounting viewpoint. Okay, so again, we have the sales price, the material price. We have an actual production cost of $580 per hour. Now we know that, you know, we can make any combination of 10, even outsourced, we can do 10 because there's some inspecting and packing. So what I'd like you to do is, what is the profitability per hour of product A and product B? Calculate that. And assume 5 units each, okay? Or I'm sorry, yeah. Like if you were making 10 of product A, well, I'm sorry. Sorry for my confusing. For product A, assume you're making 10. For product B, assume you're making 10. No, I'm sorry. I gave you, never mind. Sorry, I got confused. Just calculate for value stream profitability per hour. Don't do product A or product B, just do the value stream. So what is the revenue? Doesn't matter what mix of products you have. What's the revenue? What's the material cost for an hour? Doesn't matter what the mix is. What are the production costs? Again, you don't have to do product A and product B, just do the value stream in total. Because the mix doesn't matter, the material cost is the same, so mix doesn't matter. And the actual production costs are fixed. What's the actual profit per hour?
500.
500.
500, yeah.
$500.
Right, okay, good. All right, so now, let me, it's moving around, sharing and stopping sharing. Okay, so now assuming, so product B is outsourced. So assuming a mix of 50% A and 50% B. So we're selling 5 A's an hour, 5 B's an hour. What is the actual cost, or what's the actual profit of the value stream? So that's rows 25 through 29. So you have to calculate A and B, the sales and the material cost, and then put in the production costs. This is outsourced, so you got to remember that product B is, the material cost of product B is 85, not 42.
Oh, product B's.
Alrighty, let's take a look at the answers. Did you get an actual profit of 285 per hour?
Yes.
All right, so did outsourcing, looking at this using actual revenue and actual costs, did outsourcing B actually either save money or increase the profitability?
Increase cost.
It increased the cost, right? And it decreased the actual profitability because we could make product B for using a material price of 42 per hour, and our actual production costs are fixed in terms of the people and the machines. Now we're going to outsource it. We're going to, instead of paying 42 per unit to buy the material, we're going to spend 85. We're going to keep the resources the same because we still have work to do. And so we've actually decreased profitability. So again, if you look at it from a standard costing viewpoint and try to calculate profitability, it looks like you're making a good decision, but then when you look at it from an actual cost viewpoint, you're making a poor decision. And that is sort of the danger of using standard costing to analyze profitability, because, and we'll talk a little bit about this, we're going to talk more about this in a little bit. Most of your production costs are fixed. What's the only true variable production cost?
Materials?
Material. Yeah. So any thoughts, reactions, comments about this exercise?
The assumption is that all the other costs of material are fixed, even though it's direct labor. But we have to assume that.
Yes. Yeah. For lean accounting viewpoint purposes, you want to assume they're fixed. But when you use standard costing, let me just go back here, when you use standard costing and you're using a direct labor rate based on time, it turns it into a variable cost. The basis of the variability is how long does it take to produce the product. But that is not how your actual costs of labor work. You have full-time labor people. They come to work every day. It doesn't matter what they're making. It doesn't matter if orders are down either. You're still paying them the same amount of money. Excuse me. And likewise, when you use an overhead rate based on direct labor dollars, you're turning all that overhead into a variable cost. Again, it's based on time. And in certain training that I do on lean accounting, I basically say that time and cost has no relationship. But standard costing, that is built into standard costing, that there is a relationship between time and costs. And if standard costing has been used in the company for any length of time, it's baked into the way people think. And they think product B costs more than product A. How can we reduce the cost of product B? Well, let's outsource it. Does that make sense?
Mm-hmm. With my experience here, it's already done that we already consider overhead as fixed. But in our culture, that's going to be a little harder to switch the direct labor to the fixed.
Yeah. Yes. Yeah. Well, that's good. I mean, again, it's you know, the basis of this course is a lot of what we've experienced over the years, and you know, some companies have done what you said. You know, they recognized overhead is fixed. I mean, I've had some companies that use standard costing, and they basically say, hey, we ignore the variances. You know, they're there, but we just don't deal with them. We don't even pay attention to them.
Mm-hmm.
All right, so let's talk about solving the problem. So, you know, we define the problem about, you know, the weaknesses of using standard costing to analyze profitability. So the idea is internally to use value stream income statements. So what is a value stream income statement? It is, you have to think of it as an internal analytical tool used by managers for analysis and decision-making purposes. It really is just a different format. It's presenting the numbers in a usable format for internal users. Just like that example I showed you a little while ago, the standard costing-based income statement, you just change the format around and it makes a whole lot more logic. It's more logical to people. It's important to understand that the source of the information is the general ledger. This is not a second set of books. It's not a new method of accounting. Okay, it's a lot of times when accounting and finance people first hear about value stream income statements, like they'll say, oh, this is just more work for us because we have to report externally under this format. Internally, we have to do another format. Well, okay, so yes, there is a little bit of extra work, but you have to really think about the value stream income statement as any other report or analysis that you do on a regular basis. And if you looked at all the reports and analysis that you do in accounting and finance, you're just adding one more. And so if you're trying to move to value stream income statements and that's the way accounting and finance is reacting, they need to learn a little bit more about what we're talking about. We're not abandoning your external reporting format. This is more just internal use. So the primary difference between your external reporting financial statements, which are required to be presented in a certain format in compliance with reporting requirements. And sometimes the compliance issue will hide or mask what's really going on operationally, just like those variances in absorption. You know, when you look at it in standard costing, it hides them. So we're looking to put 4 practices in place in terms of how we look at costs. First of all, actual costs for the period being reported. There's a little typo there. We're trying to report operating profit, actual revenue less actual costs. We want to show the direct costs that are variable and the direct costs that are fixed. So if you're looking at a value stream, excuse me, what are the costs that the value stream really has direct control over? If there are shared costs, we want to separate them from the direct costs. And we really want to try to show more direct costs than shared costs. So for example, you know, you may have a maintenance department, which is really, it's a manufacturing support operation, excuse me. It supports all the value streams. So it's hard to take maintenance and say, well, how much goes to value stream A, how much goes to value stream B? And you sure don't want to do it by doing any kind of time tracking or work order tracking. That's waste. But what you do is you can create a simple way to assign the cost. We'll talk about that in a couple minutes. And finally, any kind of allocated costs need to be segregated. And we saw that on the second example that I showed earlier, where all the inventory valuation numbers, which is a cost allocation system, was summarized into one inventory adjustment number, and it was below the operating profit line. Any questions? All right, let me just put this up. So it's important to have clear definitions inside your company of variable costs and fixed costs. Now, as I said, when I asked the question earlier, if you're in manufacturing, the only true variable cost that meets this definition, it varies with short-term changes in volume, is material. Everything else does not work that way. Now, of course, you can go in and make people make cases that, everything is fixed in the short term and variable in the long term, things like that. But we're not trying to get into these sort of debates. We're trying to look at how do these costs really behave? And the primary difference between a variable cost and two differences between variable and fixed costs. Variable cost varies with short-term volume. Fixed costs do not vary like that, and they are more influenced by management decisions. So, your full-time employees, fixed or variable?
Most of the time they're fixed.
Yeah. So you said most of the time. When would you consider them not fixed?
Well, if you have staff that you bring on to deal with, let's say, seasonal, production volumes, things like that. So,
yeah, would they be considered temporary in your business?
Yeah.
Right. Temporary. I was good. That was, again, you're getting, you all are good today. You're anticipating my next question. Temporary employees, fixed or variable? Variable, because you can tell them not to come in today.
I've worked in some places where they're called temporary employees, but they pretty much are full-time. So but that's a different story.
Oh, well, is that for benefit purposes or something?
Yeah, I used to work in a place where they literally would let people go right before their 90 days, because if they were over 90 days as temporary employee, they got accepted into the union. And
Yeah.
So that was their way of, managing that scenario.
Yeah, I'm strictly talking about true temporary employees that they may have a time, they may have a time limit, a long-term time limit they can work, or a certain number of hours they can work. But they can come in. I mean, you can tell them, we don't need you today. We don't need you tomorrow. So that truly is a variable cost. And then what about overtime? Fixed or variable?
Variable.
Yeah, it's variable. However, a lot of companies I've worked in, especially in operations, overtime is almost considered regular work. But anyway, so, the thing is, and you really have to have a discussion inside your company to make sure that there's consensus on how people view the actual behavior, how these costs actually behave. And you got to take it out of standard costing system. Just talk about the costs. And talk about the costs in total. Again, each type of cost in total, don't talk about how they show up or how they're calculated in standards. So in general, there's more fixed cost than variable cost. Now in manufacturing, I think there's more types of variable costs in manufacturing. If you're not in manufacturing, there's very few variable costs. I did work at a software company, and we really couldn't identify any true variable costs. Everything was fixed because it was mostly people. So your actual value stream costs, all the people that work in the value stream. We look at who's in the value stream. We don't really think about direct and indirect anymore. All right. The materials that you use. And when we talk about actual material cost, we're not talking about this standard cost of goods sold. What we're talking about, we try to show the actual material that is brought into the value stream. So that could be how much was purchased or how much was issued. And that's a different way of thinking about material cost. Because what are the three possible, when material comes into a value stream, there's three things that can happen to that material. What is it? What are those three things?
Made into product.
Yes.
Be lost as waste, or
yes.
Scrapped.
And increase the inventory.
Or inventory, great. Yes, you can ship it, you can scrap it, or you can stock it. And so what you're trying to do, you're trying to change operating behavior to influence costs. So think of this from a lean viewpoint. If a value stream income statement shows the total material coming in, now you can hold value streams accountable for scrap and stock. And if they work to reduce stock, if they work to reduce scrap, then they see an immediate direct financial impact on their value stream income statement. Does that make sense? You can also look at the machine and equipment costs, depreciation, repairs, maintenance, tooling, anything else that you can specifically identify to the machine. Maybe if you have service, outside service for a particular machine, and then anything else. You might have some specific supplies which are applicable to one value stream or not. But you want to get it down to what costs does the value stream have real control over through decisions and operating practices. Then you can have shared cost. Oh, go ahead. I'm sorry.
No, I was just going to say, it sounds really good and it makes a ton of sense, right?
Yeah.
The application or I can't speak today. Operationalizing of it is the challenge. Am I not correct?
I think so. Just explain what you mean.
Well, unless you have an SAP system that tracks every part going into a value stream, every component, it breaks down labor as to who's in what area at what times. It's going to be hard to track those values.
Well, it's not okay. If you design your value stream income statement, it's really, and I've helped companies go through the process, and it's really what I call a mapping process, where you have your expenses sort of on an Excel spreadsheet in a couple columns, and then you have your value stream cost categories by value stream in rows. Mm-hmm. Oh, sorry, I said that backwards. You have your expenses in rows. Then you put your value streams and the cost categories in columns, and you really just map everything. What you find out a lot of times is certain department costs all go to one value stream. And then you'll have some that you have to decide, well, okay, how are we going to charge the expenses that come into this general ledger account a little differently. But it is possible to create it, and it's not difficult. Once you've done the mapping, then it's a matter of really getting into your system and just assigning. If you can create the template of the value stream income statement, and then you can assign the expenses, you can automate it. Because remember, we're looking at costs in total. We're not looking at costs by transaction or cost by product. That's the main difference. So that's a long answer to a short question.
No, it is. It is for our business, which is unique from what I'm used to. Is we basically on our production lines, we are continuously changing the products that we're running. So, it's not like we on our value stream we run one product, and that's the same product we run day in and day out. I mean, we literally our machine centers switch from product to product to product, on a daily basis. So, that's where I'm thinking of the complexity of it, in that I have different raw materials coming in. I got different labor I'm using. I got a whole lot of different things I'm using in and out of the process on a day-to-day, hour-by-hour basis. So
yeah, and it's this gets into the discussion, which is difficult to do without actually understanding or actually seeing the physical layout. It's how many value streams do you have? That's the other question. But again, we can talk about that like one-on-one if you want. So the shared costs, things like facilities, production monuments, and operational support. And you create those, you create simple ways to assign those costs, facilities based on square feet. Production monument is just a shared resource that there's maybe a machining operation and initial raw materials are machined, and then they go into one or more value streams for more assembly work. That's an example of that. Operational support, I mentioned maintenance, quality, engineering, things like that. And so creating a value stream income statement is really, you sort of follow principles and you create one that works for your company. Okay. And that's really the key. It's not like a formula, A, B, C, D, E, and then you have one. And you have to think about how many value streams you have, what's the flow of the products, and where are the people assigned, where are the machines assigned. But it can be done, and many, many companies do it. It's a matter of also getting the right people together to do it. And when we work with companies and help them, it's with a cross-functional team. It's not something that accounting and finance does on its own. It's usually accounting, finance, and operations that get together and figure out this. The great part about doing it cross-functionally is you're getting your customers involved, operations, and they're gonna help give you the information you need to produce quality value stream income statement. And the last thing is segregating allocations. I showed this is very similar to what we showed at the beginning of the workshop. So in this case, you have three value streams: motors, systems, and spare parts, actual revenue, actual costs, actual operating profit. this company had a new product design value stream, which has expenses, but no revenue, obviously. Then all of the other support costs, general administrative costs, go into support. And you can see very simply, what's the operating profit based on actual expenses. And you can see how accounting and finance in the box in the lower right, how they value inventory, how they do a required corporate overhead charge, and you get to the division profit, which is what's being reported of 152,000. All righty. Any questions? We got a couple minutes left. Any other comments or reactions to this?
It's about your last. If we can come back.
Yeah.
So we have a division ROS 9.9%. Do you need to provide the contribution on, right after the material cost? What is the what is this rate? But after material cost, and work with that for all.
Yeah, you're talking about contribution margin?
Yes.
Yeah, I mean, contribution margin percentage is a very good number to use in value stream income statements. Yeah, you can provide that if you want. Again, this is just one format.
Okay.
The format of your value stream income statements is based on what meets your customers' needs. That's the easiest way to describe it.
Okay.
All right. Anybody else have any closing thoughts? So what did you learn today? Anything? What stood out today?
I learned that I can't download documents from the chat.
That's good. Okay. All right. If you haven't, did you get the others via email?
I did.
Okay. All right.
Yeah, no, I think for me, looking at this today, it really kind of shows you how accounting can impact your judgment on being profitable in a value stream or not. And I tackle this problem every day. As the as director of enterprise excellence, I'm trying to put in measures for cost reductions and standards for developing costs, and I'm constantly running into the variance cost way of calculating these out. And so this is really showing me the difference, and gives me something to really think about for next year, not this year coming up, but how do we change our mindset to calculate the cost differently?
Yeah, no, very, very good points. Yeah, and that's really, you said, I'll let everybody go. I know we're a minute over, but you made a good point there. It's about mindset and thinking. And, the cost, the numbers that you use in the business drive thinking patterns. And so you have to sort of take, as a company, you have to take a step back, especially if you're a lean organization. You have to say, how do we want our people to think? And how do we want them to behave? And, that's all baked into lean tools and practices and principles. And really, lean accounting is, what are the numbers that we need inside the business to support this? Mm-hmm. And you know what? I'll just say, it's not standard costing. Okay. It drives, standard costing drives lean people crazy. And I think you sort of explained that to yourself. Anyway, all right. You have any questions between now and Tuesday? Don't hesitate to send me an email. I will be sending out the recording as soon as it's finished processing a little bit later today. Everyone have a good weekend, and we'll see you on Tuesday, okay?
Thank you.
All right.
Thank you. Bye-bye.
Bye.